Volume switched off. We start the market talk today. There are too many opportunities nowadays, so let's make lots of money. This is actually a Pet Shop Boys song, right? So for all those who don't know this, so this is a song, right? So what is the situation? India is the fastest growing economy, plenty of risk for the global economy. World growth forecast is around 2.2%. India is around 6.6% for FY24. So there is a growth differential, hence a lot of money is coming into the markets. What is working for the red hot market in India is that we have a vibrant IT services, domestic digital economy is good, strong, attractive location for global manufacturing. The rest of the world is suffering, so this is a reason maybe money is coming. So it's like a cleanest dirty shirt in a filthy closet. So Kotak Institutional Equities called it a mad cap dash. Why? Because the BSE mid cap and small cap indices are up for 35 to 40% year to date, and crude oil is up to $94. Rupee has depreciated. Retail food inflation is very high. Rainfall is deficient. So the primary driver of this rally is the irrational exuberance among investors with high return expectations. Because the past returns are good in stocks, not of the results of the company. Since the returns are good, people are expecting that future returns will also be good. So just keep putting money. Low reading of India VIX, it's around 11. The fear gauge indicates an extraordinary degree of complacency. But you all would be aware, some guy has said that markets can remain irrational longer than you can remain solvent. So things are good, and a lot of companies are using this buoyant equity market to raise money, indicated by number of IPOs. Most of the IPOs are obscenely priced, as we have seen with RR Kabel or now the latest ones. So this is the basic problem. Large proportion of demand for these IPOs is also coming from mutual funds, insurance companies, pension funds, and just for information, mutual fund AUM has reached around 46 lakhs crore now, with an SIP of roughly 15,000 odd crore per month. Now, keeping that in mind, CAMS, which is the largest registrar and transfer agent RTA for mutual funds, offers a unique opportunity to participate in the strong growth of the asset management industry. Why I said CAMS, why I prefer CAMS is over the AMCs is AMCs are always affected by some regulatory actions, but CAMS that way is not that dependent. It has a market share of 68.7% in AUM of mutual fund industry, largest RTA, low business risk and regulatory risk of which affects the AMC stocks, because I think they want to reduce the total expense ratio which the AMCs are likely to get, which will lower their earnings. It's also getting into insurance repository. It will also benefit from digitization of other asset management things like insurance. ROE is roughly 39%. It is expensive right now at 34 times P for FY25 earning. But comparatively to HDFC AMC, where the ROE has been declining, uh, this is still better. At least the ROE is constant or going up. It is getting into AIF, CAMS Pay, insurance, Think 360, and other businesses. Now, another interesting thing is Jamna Auto is in a sweet spot to take advantage of the current CV upcycle, commercial vehicle upcycle. So everybody would be aware of that. It specializes in suspension products for CVs, tapered leaf and parabolic springs in CVs in India. It supplies to all OEMs: Tata Motors, Ashok Leyland, Isuzu, Mahindra and Mahindra, Volvo, etc. So what is likely is that CV industry will have at least 10 to 15% growth in FY24, and they have cut down their debt, brought in some operational efficiency, so has led to improvement of ROE to around 23%. So uh, if you give it a FY25 EPS of around 6.5 to 7 rupees at 18 PE, it is still very least expensive or at a discount to its peers. The only problem is, I will cover later also, that CV cycle, commercial vehicle cycle, is a cyclical industry. So after 1 or 2 years, if it turns, then there is no demand for these stocks because their sales go down. The other one stock which has run up a lot is Mazagon Dock Shipbuilders. Risk is now in terms of execution, which is not adequately factored in the valuation. It has robust order book. Stock is trading at now 38 times PE. Shipbuilding cycle is actually non-linear and execution moves at slow pace. EPS is for next year or this year is I think around 54 and next year around 60. So order book is though 5 times revenue. Uh, at I think it has reached around 2000 plus. So at these levels, it is pretty expensive for the risk it offers now. So every good thing is adequately priced in. Now let's see some technical aspects. Uh, this is Nifty 1 day chart. If you see, this is the Fibonacci extension part. So we had a high of in of 1994, so roughly closer to 20,000. Then it went to a low of around 19,200 or 19,226. So this extension now has crossed 100% retracement, and now it is, as per the first target, is roughly 20,469, which is slightly unlikely, but you never know because last 10 to 11 days has seen constant rally, and even last Tuesday when there was a dip, but after that it has still taken off. So you can, it can possibly go for higher targets, or the other possibility, it retraces and then gathers momentum and then goes up, because actually the momentum comes with retracement, because right now the market gets overbought. Again, if you see, this is a daily chart. If you see, RSI is overbought, and whenever the RSIs have reached of Nifty has reached the overbought levels, markets have always corrected. So you can judge from there. Now, from here, if you see, if you draw the trend line, it is about to reach that rising trend line. So this is the roughly around 20,300 level. So one has to be cognizant of this level. Now let's see Nifty weekly chart. As I showed, there is a flag and pole pattern. Now it has taken off from after making the flag here. Now, as per the this patterns theory, it says that the length of the extension would be equal to length of the pole. So this length of the pole was roughly 3,000 points. So you can expect another 3,000 points over a medium term above 19,200 from here. So that takes it to roughly around 22,000 for Nifty, technically a target. Now, what I have found is that discussing option data is more important than discussing the technicals. So, if you see, this is the Nifty option chain for next week expiry. Highest open interest on call side is at 20,300, and highest open interest on put side is at 20,100. So which I have marked, and 20,200 is roughly in open interest is basically a strategy. So these would be the limits, or it's again very simply, let's explain it to people who would like to understand. Put writers are providing support, so their premium out here is around 44 points. So roughly the support will reach up to around 20,050, because at least till his premium, this guy will not book out. So 20,050 here, and call writer again here is again if you see is around 45. So 20,350. So as per the option data, the range should be for next week should be 20,050 and 20,350. Now let's see the put call ratio. See, this is the number of puts and this is number of calls. So the number of puts is roughly 15 lakh and this is 13 lakh calls. So that means the put call ratio is higher than 1. It is approximately 1.15. That means the market is bullish. That means more people are writing puts that they are not expecting a downside from here. Bank Nifty or Nifty Bank, if you see again the same retracement level, uh, it went up and now it is reaching roughly 100% retracement level. So it can go up from here. And Nifty Bank has some part to go because the stocks haven't moved much. And most of the movement has been because of HDFC Bank only, which has moved around 100 rupees in the last few days. This is the PSU Bank Index. See the rising trend line. It has broken through the rising trend line and it is heading up. So this is the part of the market where one has to be focused on. This is the Nifty Public Sector Enterprises Index monthly chart. If you see, it has broken out from the from its last high, and now it is heading for a blue sky territory, and it is likely to do well. So all the stocks which are in public sector enterprises, everything, utilities, defense, railways, banks, everything is doing well, and banks specifically because these are the ones which are underpriced right now. IT index, if you see again, this is broken out again from the this year's 52-week high level after two making double bottom here, double or triple bottom here, and now it is heading up. So it can maybe test 36,000 or 38,000 in some time from here if the results are good for the next quarter. Sorry, this we have covered. This is the momentum index. So if you see here, uh, median line of this pitchfork acts as a resistance, and now it tried to break through that, but it stopped there. So let's see where this momentum index goes. Uh, Midcap index, like last Tuesday, if you see here was a big red candle. It took a sharp knock, the mid-cap index, and stocks, some of the good stocks, leading stocks were down 5 to 10%. But Nifty has recovered and finished well, if you've seen that. But in mid-caps and small caps, recovery is not full, and sentiment is bearish now. Uh, Stock and sector rotations are becoming rapid, and moves may not be long enough to entertain swings or positional trades. So you have to be careful here. And the good point here is that it took support at 20 EMA. So then it took support at 20 EMA after the fall and then has started rising from there. So we need to watch. 20 EMA would be critical level here. Small cap index similarly, it broke below the 20 EMA on the next day also, but it then went back and now it is trading above the 20 EMA. So, what I am trying to say is that you have to be quick in entering and exiting from trades, especially in mid caps and small caps. So, better to see the momentum and price action than take position on news and order books only. Because we have a tendency that you get one good news, you start going long on a stock, which is not correct now. Maybe that good news may be fully priced in. This is the HDFC Bank monthly chart. So if you see here, in August, it took support at 20 at its 20 EMA, approximately 1563 or something like that, and then it has given roughly 100 rupees from there. So let's see where it goes. But this would be a decent support for it, and this is the one which is giving strength to the bank index. The Indusind Bank stock, which I spoke about, it has broken through its declining trend line, and now it is heading up. So this is a stock which is in momentum and can easily get 50 100 rupees from here. And when I was mentioning about PSU banks, so it's one of the PSU banks which is doing well is Union Bank. This is the monthly chart. If you see, this is its lifetime high, and from there is a declining trend line, and it has broken through that. The first resistance is 112.55, which is the 200-day moving average. So if it is able to cross this, and then it is likely to go up. So watch out for these levels. So the people who are here for immediate trade, this is a level to book out. Now the stocks which we will discuss today, this is interesting stock. First one is Craftsman Automation Limited. Uh, this is from a CV focused player. They were supplying stuff for the CV industry with machining ferrous casting products like cylinder blocks and cylinder heads. Now, what they are doing is they are evolving as a much larger diversified player in the last couple of years. This is because, as I was mentioning, commercial vehicles is a cyclical industry. The demand is not like two-wheeler demand or a personal vehicle demand. So the beyond the traditional powertrain segment, it has added and expanded on personal vehicle and two-wheeler markets through the aluminum component segment. Aluminum, why aluminum? Because aluminum is a lighter metal than iron. Hence, where electric vehicles are involved, people are looking at lighter vehicles so that the effect on the vehicle is less or the power requirement is less. Uh, Craftsman Automation has shifted to a 22% plus ROC, generating well diversified personal vehicle, commercial vehicle, two wheeler OEM demand driven, less cyclical player. Expected to deliver 20% revenue CAGR over the next 2 to 3 years, led by a combination of DRA acquisition. DRA, there is a company which they have, DR Axion. I'll discuss this later. They acquired recently. So that shows that company is able to do good capital allocation, and it has added on to their margins and revenue growth. They are likely to do continuous growth in the personal vehicle market, especially in the utility vehicles, especially the SUVs where there is a lot of demand, and revival in two-wheeler production and rising focus on industrial farm equipment segments. The point here is that the commercial vehicle cycle may peak in FY25, maybe another 1 or 2 years, and transition to electric vehicles in two-wheeler will be value dilutive oblique per unit, but it will benefit from rising revenue in aluminum casting and non-auto focus ferrous casting and machining. They are doing diversification to reduce the, basically, as I brought out the commercial vehicle exposure. They acquired DR Axion. It's a Korean company operating in India. So if you expect a revenue CAGR of around 20% for next 2 to 3 years, ROCE will improve from 20 to 24%. Aluminium casting capability for aluminum cylinder blocks for Mahindra UVs they are doing utility vehicles. DR Axion is a Korean casting player, so they have also added new personal vehicle clients like Hyundai, Kia, M&M, expanding their export revenue by getting orders from Daimler, Isuzu, and Stellantis. So FY25, if you take a EPS of around 210 to 220 at 25 times PE, it should trade at 5,000 plus. So it can go up by another 10 to 15%. Now let's see the profit and loss quarterly account. The sales are rising as you see. The margins are now reached again 20% levels. The net profit is going up and the EPS is also rising. So it is in a good spot right now. If you see the projection for the next this year and the next year and FY26, it is expected to improve the margins. EPS is also expected to be growing uh, by around 25 to 20% every year. ROC is improving to 25% and ROA is improving now to around 20%. So if you see, it is doing capex. Capex per year is increasing, and the free cash flow is also rising. So in case the free cash flow is good, so the company's requirement of debt reduces, and they are able to do acquisitions without taking any additional debt from internal approvals. They are improving the ROE, and net debt is decreasing. So this is the best case scenario. Over this is what is expected from there. So if you see, capex they are doing good cash flows, better ROEs, and lower debt. This is what you look at for investment purpose. Now let's see their chart. You see, it had a dip in March because I think the March quarter results were bad, but then it has gone up from there. Now in this fall, it has gone to around 50 EMA. So this 50 EMA level of 4,600 should be a decent level to make an entry in case you have a long-term horizon for this stock. Next stock, which I find interesting, is Astra Microwave. Somehow, it's a multi sector player. It's engaged in design, development, and manufacture of subsystems for radio frequency and microwave systems, primarily used in defense, space, and meteorology. Product range includes radars, missile electronics, electronic warfare satellites, monolithic microwave integrated circuit and communication systems. 56% revenues is from defense, 40% from exports, including deemed exports, and balance 4% from space and others. Order backlog as roughly around 1580 crore as of June 23, that is 1.9 times FY23 revenue. Now it will benefit from government's focus on indigenization, increasing usage of electronics in defense and space, strong order backlog, healthy order pipeline, and execution of high margin domestic orders which will drive their earnings in the next few years. Domain expertise in microwave and radio frequency systems and applications. They have a strong R&D and manufacturing capabilities inbuilt. So they don't have to, get technology and pay for it from abroad or something like that. They have a capability of designing and developing gallium nitride transmit and receive modules and are currently working with defense agencies for incorporating such TRMs in modernizing existing radars of upcoming fighter aircrafts like Su-30 Mark 1, LCA Mark 2, and AMCA. This is advanced aircraft which is being developed. For since their P&L is not uniform, so I have taken the yearly figures. So if you see yearly, the profits are going up, revenues are going up. Now the margins have started again improving to around 18%. So they're expecting around 20% margin. And net profit is also now going up because the revenues have gone up. And EPS has as good as nearly become 80% from over the financial year 22-23. So that is very good. What it has achieved is 20% CAGR growth over last 3 years and 21% EBITDA growth and net profit growth of 16%. And what is projected for the next 2 years is 15% revenue growth, 26% EBITDA growth, and profit growth of around 46% over the next 2 years. Their product range, if you see in defense, is radars, electronic warfare, missile electronics, telemetry, counter drones, space, flight model application, ground-based application, INSAT MMS terminals, MSS terminals, hydrometeorology, water level measurement, bubbler radar sensor, automatic weather stations, automatic rain gauge, and agromet met stations. Other areas of work, antennas, MMIC, contract manufacturing, homeland security. So if you see their chart, it's a very interesting chart, and one has to be very careful with this stock. I have found that it moves in cycles. So it will move up and then it will go below its 200 DMA. Every time this is happening, this is the 200-day line. So there will be 1 or 2 quarters of bad results. The stock will fall below 200 DMA. Then positive news will come, good results, and it will fall. It will again rise. So this is a kind of a regular affair with this stock. So one can't be really sure about their other capabilities. So the best thing is to buy it on good retracement now. It is right now pretty hot. So one has to be careful here. They have a strong research and development and manufacturing capabilities. So the point is that would they have revenue visibility and profit visibility over the next 2 3 years? That has to be seen. FY25 EPS, as I've shown, is around 15 to 16 rupees. So at 30 35 times, it should trade at 480 to 520 level. So there is some another 100 odd rupees where it can go up from here in a few next year or so. Clients are MOD, DRDO, ISRO, defense PSUs, and share of defense electronics is projected at 40 to 42% of defense production from the present around 35%. So if the electronic share in the defense production goes up, so their revenues will go up. Exports are contributing around 19% of the order backlog, and space is around 12% of the order backlog. So with ISRO and other people involved, there is a good revenue and profit visibility over the next few years. So this is the stock to be kept in mind. Now, the one sector which is in huge focus is electronics manufacturing services called EMS. It's a decadal theme for investment perspective. Import substitution and rising penetration in domestic market provide large opportunity for the Indian EMS industry. After mobiles and LED TVs, PLI scheme for IT hardware, including laptops, tablets, router, etc., is a big opportunity now. Next, railway, power infrastructure, mobility are other verticals opening vast opportunities for domestic and export markets. And semiconductor manufacturing is another big opportunity. Now, I have just gone through the data of these EMS players, and there may be a number of others who may be unlisted. Now, all of them, except few, have done well. So, if you see there, now let's take an example of Amber, right? So, EPS is expected to double in FY25, but if you see in between FY20 and 23, it had zero profit growth, though there was a revenue growth. So that means the margins were declining. So that is the risk of these stocks. Now, projection-wise, revenues are expected to grow by 27%, EBITDA, PAT by 40%, but the risk is there. Same thing if you see with Allen also. No profit growth over 3 years. And the stock went for a listing now, and it is down around, I think, 30% from its listing price. I think last year was the, or this year was the IPO. And similarly with others. No, the projections are very good, right? Or the past history is good. So can they replicate that? All of them, that has to be really seen, right? So, and the for EMS, the PCB components right now, the printed circuit board components are imported from China only, and therefore the supply chain and inventory management plays a crucial role. Either they are OEM players, that is, they are manufacturing goods on others' designs, where everything, inventory, production, everything is managed by the contractor, or they are ODM, that is original design manufacturing guys. So there the margins are higher. OEM model has lower margins. That is where the Dixon suffers. So they are basically relying on large volumes and order books. Amber's, like let's take an example of Amber versus Dixon. Amber's AC business, everything is managed by them. So the product is their own, but OEM guys like Dixon, they make stuff for and with the for other companies. So like if they're making stuff for Samsung or Xiaomi, the model goes with the name of Xiaomi. Now, if you see, Amber makes ACs. Avalon, Avalon, if you see here, uh, it is into making design production of printed circuit boards, wiring harness, sheet metal, magnetics, rail for railways and aerospace space. So it had a good revenue and profit growth, and then I think they took out with their IPO now. So one has to have the see how they perform over a period of time. Then Cyient DLM, again their stock has gone up. They derive their revenue from BL and also from medical, aerospace, and defense space. Then Dixon, we have they are suppliers for Lenovo, earpods for boAt, Xiaomi, ODM in lighting, TV, washing machine, IT hardware. Again, now they are trying to get into it. It's an opportunity. Next is Allen. Again, lighting and fans. So what happens is, in case they're the people for whom they are making the stuff, that company doesn't performs, so their production and everything suffers. Canes, they are making this. Canes are making the ventilator equipment, POS machines, servers, smart meters, UPS, automotive, railway signaling systems, EV charging setup, and I think they are trying to get into semiconductor and all. So all these businesses require capital and strict margins and other issues. Yes. Next is PGEL. Uh, Washing machines, ACs, coolers, consumer electronics, LED TVs, then Sirma SGS set top boxes for Geo, smartwatches, water purifiers, laptops, energy meters, RFID board for healthcare and all that. My point here is for all these stocks is that they are right now on top of the cycle, so there is no valuation comfort for them. So the best thing is that you have to wait patiently for a dip to enter these stocks. At these levels, everything good is priced in. So all these estimates for the next 2 3 years are estimates only. It may not work out like that, and there may be other competitors, and something can always go wrong. So one has to take a big call. But if you're invested, please stay invested. But fresh investment is slightly difficult here. So I have finished. We will take the questions now from here.